Morning, everybody. Thanks for joining us for another Tango Nonprofit Education event. Today, we're going to talk about COVID and some of the impact with the financial reliefs that are pending. Amber Tucker, CPA from FML with her partner, Bill Claffey, are going to be speaking and enlightening us in that realm. Before we get started, I just want to give everyone a quick update on some things that are of just a little backdrop on where we are with Tango as we walk into 2021. If you could fast forward the slide, whoever is driving here.
Would be me.
Why don't we go one more? There we go. So as many of you know, and probably a lot of you have seen this slide, we're often asked, why Tango? How did you create Tango and why? Well, the Shuster Group, the founding firm that I started 29 years ago, has always had a focus in working with nonprofits, with employee benefits, insurance, and the like. And about 13 years ago, I thought that there was a better way to do business. If we could put our efforts in such a way that we aggregate groups together, we could probably create some scale in the market and really do some innovative things. And, you know, capitalism should not be at odds with community support, that there's a way to blend your work efforts with goodwill. We all sort of have a spirit, if you will, or a philosophy in Tango of doing well by doing good. And when you look at what we've built over the years, we have a group of socially conscious businesses that support the nonprofit sector through their professional endeavors. And we're over 1,400 nonprofits strong, representing about 160,000 people that work in the sector. That's giving us enormous clout to do business in a different way. So I'm very proud of what we've created, and we're starting to see some real measurable results come from this partnership. Next slide, please. As you know, all of you nonprofit folks out there that are members, thank you for joining Tango. It is free. It's free simply because our partners, our for-profit partners, pay a fee to be part of Tango. The staffing we have at Tango does a great job. Thank you, Rob Bloomstone, who's our director of marketing, holds a lot of the things that you guys see together. You know, none of this would be possible if it wasn't for the efforts put forth by our partner group and the funds that they provide Tango with to do what we do every day in support of the sector. And I just want to give a little update on our own firm, the Shuster Group. After 29 years, as of the end of last year, we have changed the structure a little bit. We've been acquired formally or merged with a company called NFP. NFP is the 5th largest employee benefit broker in the country, 2nd largest retirement plan aggregator in the country, and top 10 on property casualty. It's a multi-billion-dollar company that has taken us under their wing and has given us the keys to run the Connecticut marketplace with an intention to have us build out a nonprofit practice group across the country. They are also keenly interested in the work we're doing with Tango. So you are going to see more and more come from Tango with a bigger footprint, simply because we have a multi-billion-dollar company behind us who is aligned with our efforts and our focus in supporting the nonprofit sector. So everyone in our firm is staying put. Everybody is, no one's leaving. This is a super exciting time for us here at the Shuster Group and at Tango, just because we are able to now take what we've built over the last 29 years and expand it and go deeper and drive more resources into the nonprofit space. So you're going to start to see some things coming out of Tango and from the Shuster Group with an NFP logo on it. That's what's going on. So we're thrilled. More to come. It's an exciting time for us. At this point, I'd like to just flip it over to Ryan Lawless just to talk about our mission and some of the resources that we're driving into the sector. Ryan, can you speak for a few minutes on what we have cooking in light of all the positive change we're seeing?
Yeah, of course. Good morning, everybody. So Tango is kind of a leg stool. So you see it on your screen, the education and training, and that's what you're participating in today. Obviously, and we run in upwards of 50 seminars a year that are all free and all delivered to you by professionals in their respected fields that are partners of Tango, and are donating their time to bring you this information. These educations also provide opportunities for nonprofits to network. It's obviously been a little bit more difficult in this technology climate that we live in today to do the networking part, but when we were in person, we often had many people lingering around after, and kind of sharing stories and sharing different things that they've been through. Preferred services, so the organizations that deliver these seminars and this intellectual capital are mostly service firms that, again, specialize working in the nonprofit sector, as Roland mentioned. And I think it's important to point out that these firms, as a Tango member, you're not bombarded with marketing information and cold calls and different attempts to sell you products from our partners. We really try to do it in a tactful way. And really what we're looking for in return as partners is when you make a change in some some area of your business, whether it be your accounting firm, your marketing firm, your employee benefits firm, we just ask that you look to Tango and have a conversation with our partners and see what advantages that they'll provide to you because you are a Tango member. They are significant, the programs that these partners have put together. And then mission support. So we have the donation depot, where we've had corporate entities donate office equipment, things like that we will give away to nonprofits. And then we have the Tango Foundation, and the Tango Foundation is in the process of reviewing applications to give money for training. So if you have somebody in your organization that you think is a great candidate to receive some specialized training around leadership development, nominate them. There's a nomination process. You can reach out to Rob. It's available on our website. And again, we are looking to give away dollars to help further people's careers. So, something that we do in on top of everything else. So.
Thanks, Ryan. One more slide, please. This is just a dovetail slide on what Ryan was just speaking about. I'll just reiterate one fact. If you guys have rising stars within your ranks and you'd like to find some dollars to get them further trained in the field of nonprofit management, leadership, whatever it might be, look at our site. Over the next several weeks, we're going to be finalizing the applicants and choosing a handful to receive some dollars. So this is one of our favorite things to do at Tango, give money away to help support the next generation of leaders working in the nonprofit sector. So please take a look at it. We'd love to have your candidates reviewed. So one more slide and we can get into today's topic.
Roland, here I thought your favorite thing about Tango was listening to me talk about financial stuff.
Amber, you're one of my favorites for sure. Amber does an incredible job as a Tango partner. She is always up for sharing her and her firm's intellectual capital. She is very, very engaged with our membership and always pushing us to do more for the nonprofit sector. So without any further ado, I'd like to turn it over to Amber from FML to talk about the topic of the day here. So Amber, take it away. And thanks everyone for attending. Greatly appreciate it and good to see you all.
Yes, thank you all for joining today. We do have some action-packed slides with lots of information to share. I also have Bill Claffey with me, who is really the technical expertise of this topic, but I bring that nonprofit niche. So some of you have maybe already listened to some of our FML webinars on this, but the good news about the next 45 minutes to an hour is we've really tailored these slides for the nonprofit. A lot of the PPP guidance and information that's come out, it's more general in nature. And we all know that our nonprofits, we have a little bit of uniqueness to us when it comes to the financial aspects to us. So those who haven't listened to us before, I am Amber Tucker. I'm a director with FML. We are a regional accounting firm headquartered in Glastonbury, Connecticut. We also have an office in Enfield, Stamford, and New Haven. We have worked together since March. We formed a small committee that is designated we meet weekly to talk about these resources that we're going to be going over. And, we talk about different client issues that have come up, different examples that we've seen, really, so we have this strong team of information that we have at our fingertips. So if you have questions, please feel free to put them into the chat, or you can also reach out to us after the fact as well. Bill, do you want to give a brief introduction about yourself and then we'll kick it off?
Sure, no problem. Thank you, Amber. And thanks to Tango, Rob, Ryan, Rollin, thank you so much for allowing us to present. Obviously, this is a significant stimulus package, the first of potentially several that are coming down the pike, but this one is significant and is going to have a tremendous impact on all businesses, but absolutely including the nonprofit world. As Amber mentioned, my name is Bill Claffey. I am a partner on the tax side of things with FML. I have a legal background, so I come at it from a little different direction, and I think we kind of presents a nice blend of thought processes with our firm. And I've been at the head of our task force. Myself and Frank Malone have been really running it, doing a lot of webinars like these. And if you've heard us in the past, thanks for coming back through the Tango series. And so we're going to get into it. We're going to talk about a number of different things. Now that we're at February 10th, you probably heard a little bit more. We did one of these presentations earlier in January. But we'll get into it. And as Amber mentioned, we're going to try and keep it structured to kind of address some of the nonprofit questions that have come up in the past and needs and so forth. So anyway, let's get into it. First slide. So we've got this Consolidated Appropriations Act that was passed. I probably should have updated this by former President Trump on the 27th of December, signed into law. And it's 5,600 pages of legislation. And that covers a lot of different material in all different aspects, whether it be financial related or other governmental assistance or other agencies and so forth. But we're going to focus on a few things here. So we're going to focus on the financial assistance, specifically with regard to the PPP. Second, the employee retention credit. And I know Amber has done a great job of trying to get the message out to a lot of our nonprofits. I think some folks may hear employee retention credit, tax credit, and think, well, that's not applicable to me as a nonprofit, but make sure you listen through that part because it is. Shuttered venue operators grant. Again, that's got a big touch point to the nonprofit world. We've got some things here on the back of the slides. I don't even know if we'll get to them. They'll be in the slides, but there's some unemployment benefits that got extended. There's some credits and deductions, which we'll briefly touch on, and then payroll tax deferrals, which nonprofits could have taken advantage of as well. So let's go to the next slide, Amber. So we're going to jump right into it with the PPP. As many of you may have gotten a round one PPP loan, you're now looking at round two. You may have already applied. The stats that we found today looks like, and Amber, those were as of what, February 3rd, I think they were?
Yes, February 3rd, I believe. Yep.
Yeah, I think the report was issued on the 9th, but they were stats on February 3rd. So the PPP program was allocated 310 billion, 315 billion, somewhere in that range of round two PPP funds. The data had shows that 83 billion has been issued to date. So, and they started receiving applications in the middle of January. So we're, 3.5, 4 weeks in. The deadline for filing for a PPP round two loan is March 31st. So that's about 26%, I guess, has already been approved or issued. They use the term issued. I'm assuming that means approved. And so with some of the restrictions that we'll talk about, the run on the PPP loan is obviously going to be less than it was back in March and April and May of 2020 when some of these restrictions were not in place. But basically what the new Consolidated Appropriations Act did is it did three things to the PPP. It allowed borrowers that didn't apply for a round one loan to apply for one. And so the provisions that were part of the PPP round one are really still in place. You've got another opportunity if you didn't apply. Why may you not have applied? You may not have applied because you didn't think you met the uncertainty certification. Maybe you just didn't apply because for whatever reason, there were some other logistical reasons you didn't apply. But if you didn't, and you got shut down in the August timeframe, you've got another shot to get a round one loan. And again, all the same principles that apply to that round one loan apply for this new kind of round one loan. It also allowed borrowers that did get a round one loan to increase that round one loan to the maximum amount that they were eligible for. So as many of you may have noticed, as you're going through this whole process back in April and May, there are a lot of uncertainties. Could you include federal employment taxes? Could you include employment and independent contractors? There was a lot of uncertainty. If you're a partnership, could you include guaranteed payments? I know that's not a factor here in the nonprofit world for the most part, but there were uncertainties. And so some folks may have applied for a loan for 100, but they really could have gotten 125 if they had applied the law as it kind of trickled in through all these various interim final rules that the SBA was issuing. You've kind of got a second shot at the apple to increase that round one loan amount. And then lastly, it allocated this $310 billion to the round two PPP loans. It also repealed the EIDL grant reduction. So if anyone got a grant, an EIDL grant, that was up to $10,000 that originally wasn't to be forgiven under the PPP loan forgiveness. It came right off the top, and it basically repealed that so that now you can kind of double dip on both those. We can go to the next slide there, Amber. We're not going to talk too much about the round one and the increase to round one. We're really going to focus on round two here. So round two, eligible entity. So it's laid out there, right? That's right from the definition within the act. You can see we've got, business concern, independent contractor. They state that's if you have an independent contractor, you may have submitted your round one loan. If you're using independent contractors, you may have even included them. I have plenty of clients I have a few clients that did include independent contractors in their payroll costs, and they were approved by the banks. And you may be a nonprofit that uses some independent contractors and may have included that in your payroll costs during a time of uncertainty going back to April and May timeframe of 2020. In this instance, they've clarified that, right? So independent contractors are not part of your payroll costs. An independent contractor can submit an application on their own. We've got eligible self-employed, sole proprietors, nonprofits. So, and Amber, maybe you want to kind of touch on this a little bit. So all the nonprofits were eligible for the round one PPP loan. And, I've kind of this was what was stated in the law. So you've got your 501c3, your 501c19, tribal business concerns. And I'm going to stop there and maybe let you comment there.
Sure.
Sure,
thank you.
501c6 is an additional piece, but yeah, maybe throw in some color on those pieces.
Right. So now eligible 501c6s can now apply for round two of the PPP. So these are all of your social or business trade type organizations, your Chamber of Commerce, and your other type of social type organizations. So they now can apply. But also just to clarify, in the 501c3s, there was some confusion in the first round of originally if religious organizations could apply. So they are considered a 501c3, even though you don't file the 990 and you have some differences in your tax requirements. They are a 501c3. So it comes down to what kind of organization you are, and then you can apply. And now 501c6s can also apply.
Yeah, so that was I felt like that was a hot topic, especially early on. Amber, I remember you and I having conversations after probably one of our other webinars on the religious organizations. So that got clarified. That eventually did get clarified. So just understand that, although we don't specifically note it in there, that you could be deemed 501c3 ineligible. You have to be in operation as of February 15th, 2020. So if you're a new nonprofit, and started your organization in March of 2020, you're not eligible. They reduced the number of employees. So call under round one, it was 500 or fewer employees. Now we're at 300. And this last bullet, I don't know anyone that didn't. I know there's fact patterns that can come up, but in order to be eligible for round two, you have to spend all of your round one proceeds prior to the anticipated disbursement of round two. And I don't know how someone's supposed to guess on when that is. I guess if you submit your application, hopefully you get some sort of approval within 10 days or so. I think that was what the SBA was targeting, was to get approval within 10 days by the banks. But like I said, most of my clients and most everyone I talked to, because the round one loan was really granted on 8 to 10 weeks of payroll, and then they gave you 24 weeks to spend it. And plus you could spend it on other expenses. Almost everybody I know has fully exhausted that at a minimum by the end of 2020.
Right. The only difficulty some nonprofits would have, Bill, is if they're also state or federally funded. So you have to use those. If you're using federal state dollars for payroll, you can't also then use those dollars for PPP. So those are highly funded by state or federal. They may be cutting it close.
Yeah, and I don't know, Amber, maybe you can comment on that. I haven't seen anything on this in terms of like the allocation procedure that you would go through for purposes of making that determination. And we're going to get into some of these allocations. We talk about the employee retention credit, but in that world where you have a state or federal grant coming in, is there a specific process you would use to designate that this payroll is going towards the grant and then this payroll is going towards the PPP?
Yes. Many of my clients are using just a simple spreadsheet. And this guidance came not from PPP, but the guidance came from your federal grants. And I say state, but it really depends on the department that you're receiving your funding from. So full federal and some state departments, but simply just keeping an Excel sheet that if I have $1 million of payroll that ties to my trial balance or my general ledger detail, splitting that payroll out and saying, okay, grant A covers 25%, grant B covers 25%, so I can put 50% towards my PPP. Just using a simple spreadsheet that kind of keeps track of where all your payroll dollars are being accounted for or funded through.
Yeah. Okay, great. Yeah, no, that's definitely an interesting kind of nuance to the nonprofit world that, although, Amber, you and I work together on a lot of your nonprofits. I mean, a lot of my clients are for-profit companies, so you just don't see that same kind of nuance.
Right.
Okay. So then the last big bullet here is this is the big one, the 25% gross revenue decline any quarter as compared to the same quarter, 2020 quarter as compared to 2019. And a lot of you folks may have heard this, seen it. Like I said, many of you may have already applied. But that just simply, you're looking at your 2020 quarters and you're saying, did I have a 25% or greater decline in gross receipts as compared to that same quarter for 2019, right? So you're comparing quarter three to quarter three, quarter four to quarter four. And so in this next bit of information, what we've done is we've gone through and listed what's considered gross receipt in the nonprofit world, because it's a little different, and we'll see on the next slide as to what a gross receipt is in the for-profit world, which is interesting. I haven't seen any additional guidance on this, but let's just kind of walk through it. So specifically in the guidance, they tell you that gross receipts for nonprofit has the same meaning as is the meaning in Internal Revenue Code section 6033, which is an incredibly interesting code section to reference, because Code section 6033 says absolutely nothing about gross receipts, has no definition. I went through it with Amber this past week because I said, I think I'm going crazy here because I don't see anything. And I don't know if you see something that I don't, but we went through it and there's nothing in there. The term gross receipts is referenced, is stated 3 or 4 times, but there's absolutely no definition. And so I think they do that. And this is not the only time that organizations have done this. The Internal Revenue Code will do this quite frequently, in that they will reference a code section that then trickles you into like 100 different code sections, right? And so it's kind of a catch-all. Just because the term gross receipts is used, they can now reference 30 other code sections. but that's where they go. But then they also, but then the SBA provides some more specific guidance, and this is basically exactly what they state, right? So we've got gross amounts received from all sources without any kind of reduction for costs or expenses. No reduction for COGS, no reduction for expenses in the earning and raising and collecting of your amounts. Amber, I'm going to table restricted grants until we get to the end here, but I want to go back to you on that one. But then they specifically say, and that includes, but is not limited to, and that's kind of an important term in statutory construction, and it's not a statute, but it's part of the SBA guidance. So I think we kind of utilize the same principles. But we've got gross amounts received as contributions, gifts, grants, and similar amounts. Right, that's probably a good chunk of nonprofit, most nonprofit revenue, without a reduction for expenses related to the earning, raising, and collecting. Gross amounts received from dues and assessments, and I believe they're just trying to give you examples here, just so you understand. Just as a nonprofit, as you're looking through it, that you're understanding what else should I be including in here. Gross sales or receipts from business activities, and just the key here is that it's really, receipts related to your exempt purpose, but also receipts that are not related to your exempt purpose. Gross amounts from the sale of assets. So this point is, and Amber and I were talking about this as we're kind of leading up to the webinar here. This is how it's stated in the guidance: gross amounts from sale of assets without reduction for cost or other basis and expenses on the sale. That may be, I don't know, maybe a somewhat fairly common fact pattern in the nonprofit world, where companies may have been holding on to securities or even assets, and they saw their grant funding, slashed by 50%, but they're trying to keep the organization obviously up and running, and so maybe they sold some securities or they sold some assets in Q3 or Q4, and through the sale of those assets, they kind of brought their revenue up to 80% or 90% of what it was in the 2019 quarter. Well, according to this definition, and this guidance is provided by the SBA, not only is it included, but you don't even get, your receipt is not even, it's not even just the mere gain, right? So if you had an asset worth 100 and you sold it for 200, you got to put the 200 into your gross receipt calculation. Versus the 100, which is really your true gain on that.
So it's really the proceeds from your sale.
Proceeds, right? I wouldn't be surprised if there's maybe some movement on that, because it just seems to be pretty harsh treatment, and you're not comparing kind of apples to apples. Because you could run into that fact pattern quite frequently. I mean, obviously, if you had the sale of the assets in 2019. That'll help you in this scenario. But it's kind of like those tend to be kind of more one-time events, and they don't really reflect or represent true operations. But anyway, that's what's in the definition. And then gross amounts received from investment income, dividend, interest, rents, dividends, royalties. So Amber, you and I were talking about restricted grants, and I know you kind of gave me a little bit of color on that, but maybe just talk through that, and then I think it fits in, but let's talk through what that is and how that also may not be a true reflection of kind of your true operations.
Right. It's unfortunately not beneficial to us nonprofits, right? So if you received a restricted gift in the year that we're doing the calculation, so you've received $100,000 to improve your facility, right? It's not helping your operations. Unfortunately, there's no carve out for these restricted gifts. So this is truly 100% of your contributions needs to be added into this calculation. So I received a few questions, probably 3 or 4 from various clients that have asked, we have restricted gifts for scholarships, we have restricted gifts for improvements or, certain programs, but unfortunately you cannot carve those out.
Yeah, and to that point, right? I mean, 2020 was such an odd year that, I can speak to this a little more, Amber, but like 2020 was such an odd year that I would think that, nonprofits that may have received those restricted grants or restricted gifts may not have been able to put those in motion because of other restrictions due to COVID. I mean, is that kind of a fair statement?
That's fair. I mean, it's, the nonprofit business, just like the for-profits, looked very different. We're figuring out how to run programs remotely, and think outside the box of how to keep our mission active So it's a very fair statement.
Okay, I think we can go to the next slide. Keep me on target here, Amber, because I tend to run long.
Yes.
Okay, so gross receipts for profit. I know this is not a for-profit seminar, but you'll see in here, and the key point here. So we've got generate all revenue from all sources. Interestingly, they say received or accrued, and so some folks are saying, well, can I use either? And so we've talked to a number of clients, and the way you read that, and again, statutory construction, I think there's that option. But the key thing here is the fourth bullet. For-profit and for-profit businesses, and by the way, they bring it for gross receipts for-profit businesses. They don't bring you to Internal Revenue Code 6033. They bring you to Internal Revenue Code Section 448C. And there's also some other SBA guidance, but they exclude net capital gains and losses. I don't understand. I personally don't understand how they could treat a profit and a nonprofit business differently. I don't know the logic. I haven't seen anything in terms of like legislative intent or SBA intent as to why they would treat those two types of organizations differently, but it's not included. And I have some clients on the for-profit side that had some net capital gains and some net capital losses, and they had them in 2020 and we're excluding them from the receipts factor. And so now they've met the test.
Right.
So anyway, just for point of reference for the folks out there. And if you're sitting there struggling and you go through your receipts test and you apply, what we had on the last page, and you're at 24% dip, but you had some your sale of assets in there. I wouldn't give up yet. I would potentially talk to your bank. And then also there may be some addition of the SBA issues guidance. It's a kind of feast or famine. They come out with a lot, and then there seems to be a little bit of a break, but this might be something where there may be a little bit more guidance that comes out with respect to the nonprofit world as folks are kind of lobbying to them saying, this is not right. It's not, I don't want to use the term fair, but it's not right. It's not measuring apples to apples. So anyway, so this question came up a lot early on in the process, right? So if you had a PPP loan forgiven in 2020, fourth quarter, most likely, if you had it already forgiven, that those are not part of gross receipts, right? So that's not going to hurt your factor. In terms of so this next bullet is really just, it's a quarter over quarter test, but they do say, if you want to measure calendar year 2020 versus calendar year 19, we'll let you do that. And it doesn't change anything. If your calendar year receipts for 2020 are more than 25% less than your calendar year for 2019, one of those quarters had to be greater than 25%. But they just do it for kind of ease of administration, I guess, in terms of not having to get a quarterly financial statement. I'm not going to go into detail here, but when you look at these slides, so this is if you were not in business for the full period. In 2019, you can measure the quarters that you were in business to different quarters in 2020. So we can go to the next slide, Amber.
We can go to the next slide, yes. But can you, maybe it's on this slide actually, make sure we talk about that if you're June 30 year end and the availability to do the annual calculation or the calendar calculation.
Yep. Yeah. It's actually the next slide after the one you got up.
Next. Okay. Perfect. Never mind.
Okay. So documentation. So this is what they're looking for, right? So in terms of you submitting your application to the bank, they're looking at quarterly financial statements. And just note that if it's not an audited financial statement, then you have to sign it. And it's kind of your attestation as to what it is and what you're reporting as gross receipts. And this next one, and Amber, maybe you could talk to us a little bit, right? So they also say, well, quarterly or monthly bank statements, which is an interesting concept because you could have nonprofits that are using an accrual basis, but now they want bank statements. And this is specifically from the guidance as documentation you can provide, and that capitalized or is in there. Right? Or quarterly or monthly bank statements showing deposits. Applicant must annotate which deposits listed on the bank statement constitute gross receipts. I don't know, maybe we'll talk to that, Amber, because you're more bank statements than I am, but it just seems like one, cash, and two, I don't know know what I don't know what they're requiring there. Are they requiring you to go on every line item and say, you know, GR, GR, GR?
Right. I think that you would have to be very detailed if you're going to go this route of supplying monthly bank statements, because if you're reporting on an accrual basis, if you're following GAAP, then your PPP calculation follows GAAP. Right. So if you get a pledge or a contribution or a grant, right, that's deemed to be a contribution, you book that revenue when it's received. You're not booking it when it's paid. So if you've received a multi-year pledge and in your monthly bank statements you have cash collected on that pledge, that's not counted towards your gross receipt number. So if you take this second bullet as your choice of showing your documentation, you're going to have to go through it in pretty fine detail if you're following the accrual method, because most likely most of those cash receipts are not when your revenue is actually being recognized.
Yeah, and it gets back to that other point of the general point as applied to all businesses, which was the amounts received or accrued. You know, can you use that cash concept? And if you did, right, you would kind of just forego the accrual concept and say, well, here's my monthly bank statements.
Right.
So anyway,
Okay.
Annual IRS tax filings. You had that option to kind of use the annual method over the quarterly method. If you have more than 25% annual versus annual, they basically just say, if you didn't file your return, you still have to fill it out and sign it and basically tell and attest that you're going to be filling it out exactly as you prepared. So, you know, the annual method, I don't know, it's an easier method, but it can be an easier method. But if you haven't filed your return yet, I don't know if it's that much easier.
Right.
Got to go through the whole analysis anyway. And then
Right.
that point you made before, Amber, on the next slide.
Yeah, if you want to just talk about the third bullet, and then we'll show the next.
So in order to use that as a third bullet, in order to use that annual reference period, your fiscal period has to have the second, third, and fourth quarters of the calendar year in it, so you can do these comparisons. So you have to, in order to use the annual method, you're not, again, I just want to be clear, you're not required to use that. You can take quarter two and compare to quarter two, and that's fine. You can use quarter three versus quarter three. But if you did want to elect to use the annual method because you thought it was easier, you have to have you either have to be a calendar year pair, or you have to have a fiscal year starting February 1, March 1, or April 1. You can't have a June 30 year end, which I know a lot of nonprofits have.
Right. So if you have that June 30 year end, we need to go to the quarterly calculations.
Absolutely correct. Yep. So first two bullets. This and Amber, why don't you
Go to the next
slide? I'm going to pull up. I'm going to have my old slide. Okay. So what we did is the SBA provides guidance in terms of, well, how do you compute your gross receipts if you're looking at the tax return, and so they tell you to add up the various line items on 990, and that was in the last slide, but it's line 6BI, 6B2I, 7BI, 7B2I, 8B, 9B, 10B, and 12, column A. And so this is basically the section from the 990. And you can see everything here in pink is what they tell you to add up, right? So line 12, which is on the bottom here, that's your total revenue. All the other things, 6B, 7B, those are basically just an add back of your expenses, which we talked about earlier. So you're adding back all these expenses, then you're adding in your total revenue, your line 12 amount, which is really line 12 is the addition of all the green items. So I don't remember if because you do a lot of 990s, certainly a lot more than I don't know if you want to kind of talk to, and you kind of see a lot of the concepts we've already talked about are sitting on that 990 form. I don't know if you want to talk to that a little bit.
Right, sure. So essentially, and unfortunately, if you're a June 30 year end, which I know many of you are, you're going to kind of have to go through this calculation quarterly. But essentially, you're going to take your total gross revenue, which is basically your contribution to your program support. It's all of your revenue, but then you're adding back any of the deductions that are on this page. It's getting you more back to your financial statement revenue. In some senses. Like if you have rents on your financial statement, you're not deducting expenses in your revenue number, right? Same thing for this concept. Investment's a little bit different. For your financial statements, we're using a realized gain number. You're not going to be able to use realized gains because it's just your proceeds that you've received, right? So you sold your investments for X dollars for the 990, and your financial statements, you're deducting your basis, what you bought it at, or that's no longer the case. So it's just your proceeds number. And then the same thing for your fundraising. So if you have fundraising events, you're just taking that fundraising revenue. You cannot deduct the expenses for that event. Okay, so it's really your total revenues and add back all of these expenses. All right, and most likely your accountant that's preparing your 990 has your trial balance groupings. So they can probably send you those groupings so you can easily do this calculation on a quarterly basis. Well, I shouldn't say easily, a little bit more understandably.
Yeah, I think this just gives you, I mean, they point you to the 990 if you're using that annual method, but whether you're using that or the quarterly method, you can kind of see how, again, I'm hoping this changes with regard to the net gains there, or the gain sale of assets, but at least right now it doesn't, because in multiple instances they provide you with kind of the blueprint to compute gross receipts, and they bring you to the blueprint on the 990, which
okay.
gross amount.
So let's go ahead and move forward, because I want to make sure we have about 15-20 minutes. So I want to make sure that we get to the tax credits.
Yep.
I know we have a couple more slides in the PPP for eligible, or the calculation.
Yep. So
eligibility.
yeah, just quickly, it's the loan calculation. It's 2.5 times your monthly payroll, similar to the round one. 3.5 if you're in the food service and accommodations industry. And just know that you can use 2019 or 2020. I've actually had some calls with some clients that were trying to use 2020, and the bank actually pushed back. But it's clear as day in the guidance that you can use either 2019 or 2020. Oh, actually, you can use even the last 12 months. So if you guys increase your payroll in 2020, you may want to look to using, and still qualified, you may want to look to use your 2020 payroll as your base for your maximum loan amount. And just all these bullets here, just make sure you understand that it includes, your gross wages, but then all these other items, right? The health insurance, the retirement benefits, your state and local taxes, and then this new category of, group life, disability, vision, dental. I can tell you that I've talked to a client, not a nonprofit, but the bank was pushing back on these other items, and we pointed them to the guidance, and they basically agreed, and it increased that client's loan from like 350 or 360 to 475. So just make sure you're educated on what's included in your payroll costs, and don't get shorted if they're trying to push back and say, well, you can only use gross wages. All right, let's keep going, Amber. I'm just gonna, the only thing here, other than the deadline, just knowing the deadline, that I want to talk about is the covered period. So this was kind of still kind of up in debate for round one. I think ultimately it landed on 8 or 20. That should be weeks, 8 or 24 weeks. And under the new round two, they say you could use anything between 8 and 24 weeks. So that could be relevant if you have, all those FTE reductions and compensation reductions, all those, like the FTE quotient, all those concepts still exist. So, if you're able to use the PPP and then have to make layoffs like in week 14 or week 15, know that you can, hopefully you don't, but know that you can, and you can cut off your PPP covered period at week 15 and then run your FTE numbers off of that time frame versus having to run it out 24 weeks. All right, let's keep going, Amber. Eligible costs. So we've got, the big four there that were in the original one, and then you've got the new costs. So there's the covered, and a detailed definition is on the next slide, but you've got this covered worker protection expenses, supply expenses, operation expenditures, and covered property damage costs. Not only are those eligible for round two, but the way the legislation was written, if you haven't applied for forgiveness yet on round one and you just weren't able to, to Amber's point earlier about maybe having some restrictions on your payroll, know that these last four categories are instituted into the round one forgiveness application, and they're applicable for round one loans. So if you're kind of sitting there and you had $1 million loan and you spent you were able to spend $700,000 or $600,000 on payroll, but could only come up with another $200,000 of utility and rent costs, you've got some other areas here to maximize your loan, even on round one. Let's keep going.
Okay, so I know these next ones are the details of it. I think we're going to skip over these to jump to.
Yeah, let's skip over that. I mean, if everyone's going to get the slides, you can look. That's, it kind of is what it says it is. So it's pretty self-explanatory. Okay, all right. Changing topics. This is the employee retention credit. This is a big one. Folks have to know about this. In the nonprofit world, we've already found a number of clients that are eligible for it, and it can be a significant cash generator. And the IRS has already issued a notice saying they're urging taxpayers to take advantage of it, which I've never heard the IRS ever urge anyone to do anything that was taxpayer friendly. But anyway, this is a credit that came through in the March 2020 CARES Act. Originally, the legislation in the CARES Act said if you got a PPP loan, you weren't eligible for the employee retention credit. So really, for 90% of my clients, this was a kind of a non-starter because they got PPP loans. It's a credit that offsets the employer portion of Social Security tax, but it's refundable. So if you had a tax credit of 100 and your Social Security tax was 7, you're going to get a refund of $93. In terms of the credit, I think I get into more detail, but yeah, let's keep going because I get into more detail on the credit here. Okay, so in order to be eligible, in order to be able to take the credit, you had to be eligible for the credit. So, that the CARES Act, this is the original CARES Act issued this credit, and again, originally it was not eligible for if you got a PPP loan. Then we bring in the Consolidated Appropriations Act, the bill that we talked about that was signed in December 27th of 2020, and in that legislation was one provision that said we are repealing the provision that provided that if you got a PPP loan, you couldn't take advantage of the employee retention credit. So everybody who had a PPP loan that might be eligible for this has to do a little bit of homework to see whether they could be eligible for the employee retention credit. So who's eligible for the employee retention credit? Oh, and also the new legislation, not only did it do that, but it extended the credit. The credit was set to expire on December 31st, 2020. It extended it till June 30th, and it changed some things which we're going to talk about. But let's talk about 2020 because those rules, other than the PPP repeal or the provision that said if you had a PPP loan, you couldn't take the credit. Other than that, everything with respect to 2020 stays the same. So how are you eligible? You have to, it's right there. There has to be a 50% reduction in gross receipts in a quarter of 2020 as compared to the same quarter within 2019. And then that becomes an eligible quarter. Or you have to have some sort of a government order that directly, fully or partially suspends your business. Okay. So 2 ways, either you have a reduction in gross receipts or you've got a government order issued by state and local government, CDC, OSHA, Health and Human Services, and so forth.
So Bill, one interesting question here that we actually didn't talk about, the reduction in gross receipts, does it have to be company-wide, or can it be this nonprofit runs several different programs and some programs are fine, but other programs are suffering? Can it be broken, the gross receipt test, can it be applied to just certain programs?
No.
Okay.
All right, let's go to the next slide. Okay, so there's a detail here on, I know we're starting to run a little short on time, but this is on the government order. What is a government order? How does it, fully or partially suspend your business? Just first red bullet there. The voluntary shutdowns are not they're not government orders, right? So if the government says, hey, we recommend everyone socially distance, and you go remote within your business, then that's not a government order, right? Let's see here. Okay, then the next couple bullets here really kind of get into, the third bullet is, okay, I've got multi-state business. Again, you're deemed to be an eligible employer nationwide, but the order has to directly impact your business. Let's go to the next slide. Okay, so so this is now we get into the gross receipts test again. So we've got gross receipts under 448C for profits, and then we've got the IRS issued an FAQ that basically tells you how you determine gross receipts if you're a nonprofit, right? So we've got total sales, less returns and allowances, total amounts received from services. Again, they go to it doesn't matter what the purpose is. If you're getting amounts received for services, investment income, contributions, gifts, grants, gross amounts received from memberships or affiliated organizations. There's no mention of any kind of sale of assets, and there's no reference to 6033. So I don't know where that stands. Just be aware that it's not specifically included in the IRS guidance, which is only a paragraph on gross receipts. In fact, in the guidance, they say initially they didn't issue what gross receipts were for nonprofits, and then they subsequently came out with this one paragraph, which is the information that I've included in the slide here.
Right. So your gross receipt test or the calculation is different for PPP than it is for this retention.
Seems like it could be. Again, it's the position you take on that sale of assets. That's not mentioned it's not mentioned in the guidance in terms of what's included, unless you read into it and said, well, that's total, so it all rolls in there. But like for for-profit businesses, they specifically state sale of assets is included in your gross receipts. They just don't for nonprofits. So I might take, I think there's a filing position there. Say, well, if you have that fact pattern, maybe you want to, and the sale of assets was hurting your revenue test. You may want to take the position that shouldn't be included because it's not specifically stated.
Right.
Okay, so in terms of, I'm gonna go a little off script here in terms of the slides, but you have to have an eligible quarter in order to be eligible, and that's either through the government order or this gross receipts reduction, right? Once you have, and let's kind of focus in on the gross receipts piece. If you have that, and it's got to be a 50% reduction in 2020, you are eligible for that full quarter. For purposes of this credit, it's actually better to, it's better to get under the gross receipts test. I know that's not what is good for business, but that's, for the purposes of this credit, that's the better answer. You're eligible for that quarter, and then you're eligible until the end of the next quarter in which your gross receipts are less than 20% of the gross receipts from the similar quarter, right? So if you had a 55% reduction in quarter two, you're automatically eligible to the end of quarter three, and then eligible to quarter four unless quarter three had a gross receipts dip of, let's say, only 10%. So then you'd have quarter two and quarter three eligible. What is the credit? The credit is it's wages paid in an eligible quarter to employees up to 50% up to $10,000, right? So if you had an eligible quarter in quarter two and you paid an employee $12,000 of wages in quarter two, you're going to get a $5,000 credit. If you paid the employee $9,000 of wages, you're going to get a $4,500 credit. If you pay the employee $100,000 in quarter two, you're going to get a $5,000 credit. And so really it's determining eligibility. And one other criteria that becomes incredibly important in this analysis is that for purposes of 2020, they had a designation of large employer, small employer. And I know that it's in the slides here, but large employer, small employer. If you had under 100 employees and you met these tests, or you're eligible under the gross receipts test, then every dollar you pay to those employees is part of your calculation of this employee retention credit, right? So if you had 95 employees and you had an eligible quarter in quarter two, and everybody made at least $40,000 a year, $10,000 in the quarter, you're going to get a credit of 95 times 5,000, right? So that's a pretty substantial number. If you had 105 employees, then you're considered a large employer. And now you're only getting a credit for wages you pay to the employees for basically not working. So how do you demonstrate that? That becomes difficult. You'll have to come up with some sort of schedule showing utilization, or if you did let's say you did a straight payroll cut, but they work the same amount of hours. Then you could say all of the pay that they received, the pay that they did not receive, that 20%, and they're still working the same hours, that would be eligible. But that's a pretty big distinction, and let's keep moving here, Amber, because we get the 2021 piece is really critical.
Okay.
Okay, so we have the large employer, small employer. If you're getting other like WOTC credits, just know you can't double dip on that. Keep going. Use of a PO does not prohibit the claim. In terms of logistics, it's the way that you want to take advantage of this program is you want to get in touch with your payroll provider. If it's for 2020, you're going to amend your form 941, and then you're going to file a form 7200 to request a refund. If it's going forward, and we'll talk about that in the 2021 rules, you can actually start offsetting all your payroll tax deposits, which you puts the cash in your hands quicker. Let's keep going. Okay, changes. Okay, so we talked about the retroactive change in the PPP. We talked about the extension of the employee retention credits for Q1 and Q2. Okay, with regard to Q1 and Q2 of 2021, it increases the credit rate from 50% of qualified wages up to $10,000 for that entire 2020 period to 70% of qualified wages up to $10,000 per quarter. So if you have an eligible Q1 quarter and an eligible quarter two for purposes of this employee retention credit, you're going to get a $7,000 quarter, $7,000 credit in Q1 for $10,000 of wages paid to an employee, and $7,000 in quarter two. Whereas in 2020, you would have been capped out at $5,000 regardless of how much you paid them in multiple quarters. It increased the threshold, large employer. Remember, we talked about 100 employees and increased that to 500. So whereas in 2020, you're going to look through it, you may say, well, we had 105 employees, we're boxed out because we didn't pay anyone not to work. And if you have an eligible quarter in quarter one or quarter two of 2021, you're now considered a small employer. So now you're getting credit for basically any wages paid. It reduced the gross receipts test, from 50 down to 20%. I'm using the term 80, but it's really a 20% drop as compared to 2019. And it also allowed a safe harbor for quarter one. You can use quarter four. So let's say you listen to this, you go back, you do your analysis, and you're like, gosh, we had a 35% dip in quarter four. So we were not eligible for 2020. And that's correct. But you are eligible in quarter one because they're allowing the safe harbor to use the prior quarter. So really opens up the program to a lot of companies. The advance, that's kind of more through your payroll company in Form 7200. So let's keep going, Amber.
Okay, so that's the last slide for the retention credits, but two questions. I've gotten a few questions, but I think I can summarize them into two. If you weren't exactly mandated to close, like say you were running a camp or a program similar to set of attendance, and you felt like you couldn't open properly, so therefore you chose not to be open, but technically government said you could be open. Does that fall in that range at all, or then you would have to go to the employee test?
I don't believe that would qualify as a government order fully or partially suspending your business. Right.
Okay.
I think that's similar. And again, this is very facts and circumstances. And that's why, if you have that fact pattern, reach out to your reach out to your accountant, reach out to your attorney, reach out to your advisors, and and go through it. The IRS has a pretty robust FAQ. Unfortunately, it hasn't been updated. So all the changes that we just talked about with 2021, it'll say right on the top of the guidance, we have not updated it for the Consolidated Appropriations Act. But those kind of questions are in there. And I don't know if that's going to change. I don't know if that's going to be updated, but they do kind of give some pretty good examples of like when, and some of those are kind of on that slide, but when the order is responsible for a partial or full suspension of your business.
Right.
And I think just based on the fact pattern you gave, that seems like that's more of a choice. And you run into the same issue with essential and non-essential businesses, right? When Governor Lamont issued his order back in like early April, March, April, May, of who was essential businesses, you know, it was very surprising as to who they deemed to be essential businesses, right? For example, we're an accounting firm. We've been remote for a long time, we were deemed essential. I guess my expectation when that first came out was that essential businesses were going to be, you know, healthcare providers and, you know, policemen and so forth. But that list of essential businesses was pretty long. And so, you know, that gets into a pretty fact specific, you know, analysis.
Right.
But if you think you have it, and I've talked to a couple clients, if you think you have it, it's worth kind of taking that up the flagpole and trying to make your argument.
Right.
And I had some clients on the for-profit side that had restrictions on travel, and their business is related to travel. They couldn't travel. They were restricted from going to another state because, you know, without getting a negative COVID test or 14-day quarantine, and that really impacted their business. And so we're trying to put together the puzzle pieces right now to make that argument. So that would be my advice. If you think you have it, talk to whoever you need to talk to, and then put together the fact pattern. There is some good guidance. It's dated, but it's I think the concepts in there are still pretty good to rely on.
Okay.
So again, this credit is massive. I mean, I found clients that literally did not know they had anything. You know, 500, 700 million, $1 million of benefit. It's a huge but somewhat unknown indirect stimulus package.
Right. Just one more clarification, and then I know we're about out of time here. If you have, oh wait, I think I'll get back to this person after. I was going to say, if for the credit, if you have no employees, then you would go to the gross receipt test. But if you did have no employees, there is no credit available.
There's no credit. Yeah, the credit is based on payment of qualified wages to your employees. So
right.
If you're not paying employees, then you're never building up the credit.
Right. That question may have gone back to the PPP. So I'll get back to you, Erica, and make sure I have your question correct. That was all the questions for the retention credit. Just one more thing that I wanted to go over in the slides real quick. And then these slides will be handed out to you, so you'll have them for your references, because we didn't get to the employee benefits and the payroll tax deferrals and that such. That's available for you. But the Shutter Venue Operation Grant, because I know some of you that are listening are potentially qualified for this. The application is not still out. Originally, our thought process was hedge your bets, apply for both. But guidance has come out that says, no, you cannot do that. So if you are waiting to see if you qualify for the Shutter Venue Operating Grant, do not apply for the PPP second round or go back to the first round, because that automatically disqualifies you. I know that if you're following this, there are various thresholds, priorities of when you can apply. So if you're at I think it's 90%, it's either 90 or 95% of a revenue loss, your first priority. If you're 75%, your second priority. So if you're concerned about that numbering, you can apply for the PPP instead of this. I think this is more beneficial as far as the uses of funding and how much you would get.
Yeah, I mean, PPP round 2 is capped at 2 million or 4 million for affiliated entities. And as you can see, the grant here is capped at 10 million. So, and potentially a better way to calculate that, right? I mean, 45,
Right.
If these venues were up and running and, doing well in 2019, that's 45% is a big number off of gross revenue. I would think in most cases that's going to be, more than 2.5 times monthly payroll. So,
Right.
and you have some additional costs here, most specifically the payments to independent contractors. So it's tough. It's a really tough situation. And in fact, the PPP loan says you have to check a box saying you're not going to get, you haven't received and will not receive a shuttered venue grant. It really puts, I think, it puts those venues in a little bit of a tough spot because,
Yes. I agree.
like
But
one in the
fact
hand
that
versus two in the bush, or two in
Yeah.
him, or whatever that phrase is.
Yes, yes. It is a little bit good news that the second round of PPP is moving slower as far as dollars out the door than the first round. But as you know, there's no guarantee. So hopefully they come out with the application really soon.
Yeah.
So that's 1210. I didn't see any new questions pop up. So I think that's the end of our presentation for today. Please feel free to reach out to Bill or I. The last slide of the slides has our contact information. Thank you for joining us today. And if you're not a member of Tango yet, I do highly suggest that you're signing up because it is a free membership for the nonprofit organization. And it's pretty beneficial. The education that I've seen comes out regularly is very useful.